Currently at risk, and will earnings save the day for the rally? Let's ask our panel. Dan Greenhaus is the chief strategist at Solus Alternative Asset Management. Lauren Goodwin, portfolio strategist with New York Life Investments, both with me at Post 9. It's good to see you. Lauren, I begin with you. It feels like all of a sudden everybody's cautious. I mean, you had this midday headline which sent stocks to the lows of the day. Israel's military chief of staff says there's going to be a response to the Iran attack. I've got BTIG's Jonathan Krinsky talking about downside potential. I've got RBC on the rising risks. Even Bull Ed Yardeni talks about a potential stall. And then Renaissance Macro, Jeff DeGraff says we're not oversold enough. You have more downside ahead. What do I make of all of that?
I think the reality for the markets is that we're not going to see a sustained downturn in the U.S. equity market until we have an earnings problem, which we do not have right now, and the labor market cracks, which is not happening right now. And so I'd anticipate that the jitters that we're seeing are a result of, yes, valuations are high. There's a lot of uncertainty. That's been true for months.
So that's a reality check that, yes, obviously risk has been introduced. And anytime there's geopolitical risk, especially in that region, you're going to get a little bit nervous. You had the market, the rally went up a lot. Tax days today, maybe some of the selling late last week was due to that. JP Morgan says they're still bullish, and here's why. And I think it plays right into what Lauren's talking about, and I think that's why we need to debate it. We don't think the rapid repricing in the Fed's rate cut expectations changes our bullish view, as above-trend GDP growth still supports corporate earnings.
Yeah, listen, I think that's exactly right. And just to tie this together, the right reasons is the important adjective, if you will.
That's why I put that there, because, right, they're not. Why are they rising?
Yes. Well, listen, you have the strong retail sales. You need to look no further than the curve itself. At the short end of the curve, rates are up, call it 2, 3, 4, 5 basis points, maybe. At the longer end of the curve, you're up 10 basis points. And obviously, some of that is positioning. Some of that is going to be worries about oil. And some of that's going to be the strong retail sales report and the idea that the economy continues to do well in the first quarter, which generally corresponds to higher or better earnings prospects. Certainly, I think better than what the consensus is looking for right now. And when you put that together, assuming the economy, to Lauren's point, doesn't roll over or something tragic happens that we don't know about, then the bias remains to the upside in the medium term, even if in the short term we need to consolidate.
And it doesn't matter, Lauren, that earnings growth expectations have come down so substantially, where it was, close to 10%, and then it was down to 7% at the beginning of the year, and now we're under 3%. For earnings growth expectations. Does that matter at all?
It appears not to matter a whole lot in terms of the pricing of the market today. It's something that we've been pointing out for months, that earnings expectations over the course of this year are high. I think what we've been seeing in the U.S. economy, though, is that there's so much resilience. And when we're looking at Q1, which is what we're in the process of sort of unveiling, there's still a lot of optimism. We expect 2% earnings growth, 3% revenue growth this quarter. That's still a pretty meaningful tailwind for the market. And to Dan's point, that doesn't mean we can't see moments of consolidation. In fact, one of our high conviction calls is that there hasn't been quite enough term premium on long-term bonds. It's an area where, with just considering the inflation and growth volatility that we've seen in the market, not even to mention supply and demand, that we'd expect to see a little bit more volatility. Not surprising that we'd see a couple days of volatility as a result.